All right. Hi, everyone. Welcome to our second webinar at MedTech Innovator Asia Pacific. So this webinar is our second one running since last week. And this week we'll be talking about venture capital versus corporate capital differences and similarities. So Frederick and Ferda are from the MedTech Innovator Asia Pacific team, and we have with us our panelists, which Frederick will introduce in more detail. So Frederick, I'll pass it over to you.
Thank you so much, Sakina, and good morning, everyone, and a warm welcome to our 2022 cohort of companies, and welcome to those of you following us on YouTube. My name is Frederick Nyberg. I'm the Managing Director for MedTech Innovator Asia Pacific, based here in Singapore. As Sakina mentioned, today's topic is a really interesting one. It's venture capital versus corporate venture capital. We'll be examining some of the differences and some of the similarities, and hopefully provide some insights and guidance to the startup community, not just here in Singapore, but across the region. I'm really pleased to introduce this panel. We have a fantastic set of panelists with us today. They will each introduce themselves in just a moment. Let me just introduce them. We have Dr. Wei Wu from Johnson & Johnson, based in Shanghai. She is the Principal and Senior Director of Venture Investment at JJDC. Good morning, Wei. Good to have you on the panel. We have Dr. Joseph Mocano, PhD as well. Joseph Mocano from Verge Health Tech Fund. He's the managing partner of the fund, normally based in Singapore, I believe, but currently in Toronto. So thank you for staying up late, Joseph. Always good to have you on the panel. Then we are delighted to welcome back Alan Goh, CEO and co-founder of NDR Medical Technology, Singapore homegrown robotics company, and the winner of the MedTech Innovator Asia Pacific Award all the way back in 2019. That was our inaugural year. Time flies. Great to have you back, Alan. I will ask each of our panelists to briefly introduce themselves. Tell us a bit about your background, your company, your role in the company, and then we'll start tackling the topic of this morning. And Wei, I'll start with you.
Thanks, Frederick. It's very nice to participate in today's event. As Frederick mentioned, my name is Wei. I'm currently the Principal of Venture Investments at Johnson & Johnson Innovation, JJDC. JJDC is the corporate venture arm of J&J. We were established in 1973, so we are going to celebrate our 50-year anniversary next year. We invest in the areas of biopharma, medical device, consumer health that are of strategic interest to J&J. Therefore, we are a long-term investor. We are stage agnostic, investing from seed Series A all the way to public companies. We can lead or follow in a round. We have a mission or mandate to onboard our portfolio company to J&J Corporate. We have offices around the globe. My current role is to cover the equity investment for J&J in all three sectors in Asia Pacific countries and regions. My background, I was a scientist by training. After PhD and postdoc in the US, I had R&D experience in startup companies and pivot to venture capital firm before joining JJDC. Very nice to meet everyone.
Thank you so much, Wei. And Joseph, please.
Thanks so much, Frederick. And so Dr. Joseph Mocano here, managing partner and I guess co-founder of Verge Health Tech Fund. And we're entirely a private venture capital fund, no kind of corporate affiliations or anything like that amongst our LP base. And we invest at the very earliest stages of global medtech companies and health tech companies in general that are looking to make a difference in health systems around the world. So we're kind of location agnostic, but as long as you're solving a really big problem in public health through technology, be it hardware or software, then that is something that we're quite interested in partnering with startups at. And since we started in 2018, we have invested in 15 companies across 13 countries. Although that sounds a little bit unmanageable, we do tend to re-domicile companies to kind of safer places and places that we're more actually physically present in by preference in order to be kind of closer to the portfolio companies. And we are a proud member actually of JLabs' Investor Hub. So it's kind of an all fun small family. And two of our companies are in JLab Shanghai as well. So I'm actually quite surprised I haven't met Wei yet, but I'm sure there's some opportunities too in the future. So that's us in a nutshell. My own background, I was a scientist first, working on new cancer therapies, kind of I like to say an accidental medical device entrepreneur, because I had kind of a side venture during my PhD that wasn't really related to what I was doing in cancer. This was in brain imaging, and that kind of took me into the world of business. That led me to do my MBA, seek a career in investment, and then a detour for 8 years in management consulting before coming back to investment, which I'm now doing full time. And it was really a path from, an angel investment to want to do this more professionally and more dedicated way that led me to start a venture capital fund. Sorry, I went on a little bit, but hopefully that's helpful context.
That's great. Thanks, Joseph. And I think several other companies in our audience will recognize you as a judge on some of the MedTech Innovator Pitch Event judging panels. So thanks for that. Alan, over to you.
Yep, thank you, Frederick. I'm Alan Goh, CEO and co-founder of NDR Medical. So we are AI image-guided surgical robotic system, bred and born from Singapore. So we are trying to bring this technology into the operating theater or intra-op CT suite in order to use imaging itself to guide interventional process. What I meant by that is in terms of biopsy, ablation, or simply anything that requires putting a needle with precision into the human body itself, be it for curing cancer or for other ailments. So in a nutshell, that's what we do. We've been around for 8 years. Our footprint has been in Singapore, Malaysia, Japan, Korea. We have clinical partners in the US as well as in Europe, but in a very small scale right now we are doing, because pretty much I think as a deep tech surgical robotics company, we are in still our initial phase. We are pivoting into the commercial phase at the time being. And I've known Joseph for multiple years. When he first started his funds, we really kind of align ourselves, given the fact that it's very difficult for medtech companies to raise. Hence, we've become very good friends since then. And with J&J, we are also part of J&J Shanghai's alumni, JLab in Shanghai. So those are some of the affiliation that I'm seeing. And a bit of background about myself. I started my career more than 20 years ago in A-Star as a researcher. That goes on for a couple of years. We were supposed to spin off as a company because we have some industry projects, but that didn't materialize. And that has really triggered my entrepreneurial spirit. And beyond that, I went into doing some manufacturing development. And right before starting NDR Medical, I kind of took my CFA. I went into a small scale accelerator that allows me to hone my skills in terms of medtech commercialization, as well as business plan, etc. And that goes, and the next 8 years is with NDR Medical to date.
Great, thanks so much, Alan. Great to have you back on the panel. So to the audience, you can see here what we're trying to do is we have to tackle our topic today is we have a corporate venture capital fund represented here. We have a traditional VC with Verge, and we're fortunate to have Alan here, who is MedTech Innovator alumni company, and who has among his investors both corporates and traditional VCs. Before we dive into the topic in a bit more detail, just a more general question for Wei and Joseph. 2022 is, of course, turning out to be a much more difficult year from a funding perspective than 2021, and obviously the war in Ukraine and so on has not helped at all. What are your thoughts on funding trends specifically in Asia Pacific at the moment, across digital and traditional medtech? And Joseph, maybe I'll start with you on that.
Thanks, Frederick. I think that there are the nuanced answers, then there's the kind of like the general catch-all answer. And the general catch-all answer is that investors tend to move as a herd. And when you see one part of the herd panic, the rest of the herd kind of panic. And sometimes this is for rational reasons. Sometimes this is perfectly rational reasons. For example, if you are a venture fund and you have a lot of dry powder that's called, which means the money's in the bank account, it's the best time to go shopping in the past 15 years. If you are a venture fund that has capital, but no powder in the bank, and you have to do a capital call, something that's not subtle is that an LP might say, hey, hold on a second, we're having some liquidity issues due to all of our write-downs. Can you please not call capital for a bit? And then meanwhile, the venture capitalist is like, man, I really, really want to invest. And oh my God, I can't call capital. Do I borrow from the bank? What do I do? And you don't want to make an LP, forced to default on a capital call, because a relationship with an LP is something that can be, 10, 20 years. And that is more important than an individual investment opportunity. So there are some nuances that aren't really talked about in the main I guess funding news channels as to why there might be a bit of a funding freeze. Sometimes it's involuntary versus kind of a reaction. And then on top of that, you do have some sectoral sentiments, some headwinds. Like if you've looked at tech companies that are listed in public markets in the US, and then as an extension of that, health tech companies that were listed in public markets in the US, and seeing the massive write-downs, the private valuations getting written down, then you have investors over here saying, hey, are those multiples that we've been using to value companies entirely appropriate, considering everything that's happening over there? And generally speaking, the closer you are to that later stage or growth stage you are, the more, beta, the volatility in the market comes into play. I would say from personal observations, valuations and expectations from really, really early stage companies are still kind of, it hasn't really hit there yet, and it might not ever hit there. But what is probably hitting there is, the confluence of all these other factors saying, we're gonna flight to quality. We don't know what's gonna happen, so we're gonna support our existing portfolio and help them get through the storm because of everything that's happening, instead of, investing in new companies. Sorry, that's quite an extensive kind of overview of the current sentiment, and certainly not comprehensive by any means, but that's kind of just like what we're kind of seeing and feeling.
Yeah, no, that's very helpful, Joseph. Appreciate that. And Wei, what are your thoughts on some of the funding trends here in the region?
Yeah, I want to echo what Joseph just said, that I think early stage companies probably are affected less compared to the growth stage or companies in the crossover stage. Primarily because the amount of capital they need to raise, and also the valuation still presents some upside from where they are today. Of course, Asia Pacific is a very broad region, so we also see country to country or region to region heterogeneity. For instance, I think so far this year, Japan and Southeast Asia probably haven't been affected as much. But also in the previous years, they probably they had a steady growth, but they haven't had the boom, like for instance, some other region like in Greater China. So they are affected less. China and Korea might have been hit a little harder this year because of the trickle down from the stock market. But overall, I think the innovation level in Asia Pacific has been improving significantly throughout the past few years, and I think that will stay, consistent in the coming years. But I think the fundraising strategy of the company and also the business model and development plan of the company might need to be adjusted according to the market condition.
That's very very helpful insight. Thanks for that, Wei. So I guess against that background, now let's focus on the topic here at hand and talk about some of the differences between venture capital and corporate venture capital. And I guess maybe first we'll start with this from a startup perspective. So I'll turn to Alan here. I know you raised about 8 million Singapore dollars in a Series A. Led by Chinese corporate Microport Scientific. Can Can you maybe shed some light on whether there were any specific deal terms or strings attached in that arrangement, with their corporate investment, the likes of distribution deals and manufacturing rights or requirements that you normally wouldn't see from a traditional VC that was sort of unique, that you were able to talk about publicly, of course?
I think a lot of things are no secret. I mean, to add on to that, Frederick, we were very lucky. Prior to raising from Microport back in 2017 or 2016, we actually raised a very small round from ST Engineering as well. I mean, if you consider them as a corporate, they do.
Absolutely.
But yeah, the typical ideology is usually corporate will want corporate alignment to their business unit, and some of the business unit within their space must sort of pledge that this is a viable business to add on to their portfolio. And that is likewise for ST Engineering as well as for Microport per se. And of course, from a corporate, they will usually require some tangible licensing rights or certain jurisdiction or geographical region of focus, whereas compared to VC, typically they want just keep it open so that the startup could venture further, in a sense, getting more traction before we kind of award some rights to specific individual corporates. And with the particular deal we are talking about from Microport, they are supporting and helping us in the Greater China region. That has been really, really helpful. In the past, me and my co-founder or my entire team, we have tried to venture into the China region, in Guangzhou, in Suzhou, in Shanghai on our own. Being that we're bilingual, we speak fluent Mandarin, but we still find it a very, very tedious process having to negotiate with them on a daily basis. And some of the way the relationship is being built is not something from a more westernized, developed country like Singapore, Singaporeans would be able to handle. So we decided after 3 years of venturing into China that a right partner coming on board would be a much better strategy than doing it on our own. And given the scale of the company, it just doesn't make sense for me to invest heavily into the Chinese market. So far, Microport has formed a joint venture with us, called Tugboat, located in Shanghai, specifically for the interventional process. So they are doing a couple of things like incorporating our technology, developing some of the elements of the product on our behalf with our specification. And to mention that in more details, we are a robotics company and we want to customize our robotic arm and system. And given the limited headcount we have in Singapore, and that has been some of the requirements that we have laid down to Microport, that you need to help us do this. If not, we wouldn't be able to grow significantly. And that has really tremendously brought down the price or the cost of goods, the COGS of the entire system in the longer term. What we plan for in the next 3 years, if you're going to see the future of our product, is going to be more affordable. That I think from a mass market perspective, is something that even the second tier, third tier city or some of the hospitals will be able to afford, rather than just leave it to the hands of the top premium hospitals. That has always been my vision, to bring robotics into the mass market. So Microport as a corporate has been helping us a lot in terms of the market strategy as well, and as well as product development. So as a startup raising from corporate, you can state your terms as well. It's not all just what the corporate requires you to do, because ultimately it's a partnership. You get to say what you want as well.
That's really interesting, Alan. Great to hear how that partnership is working out. I did want to ask you as well whether you specifically, when you were raising your Series A round, did you specifically seek out a corporate venture capital organization, and did you shortlist Microport, so you proactively went after them, or was it more of an opportunistic introduction and that turned out really well?
The real honest truth is we went for strategic investors.
Okay.
Microport is not the only investors that we look for from a corporate perspective. J&J is definitely on my list, given the fact that we are JLab Shanghai alumni. I think it was Joseph who made the introduction for me. Was it? So he connected me to
I
Sharon.
didn't know that. Okay.
I flew myself over to Shanghai to join their opening ceremony.
Interesting.
I get to know Sharon. So we decided, let's just do it.
Yeah.
I applied and then we were incubated under JLab Shanghai. J&J has been exploring a deal to invest. But of course, in a corporate world, you tend to be only able to select specific partners. There are other corporates that we are exploring as well, but whether be it CVC or VC, they fulfill a certain purpose that helps the company to progress further. As I mentioned, for corporate perspective, you need to have business unit alignment, and likewise, what kind of support we expect from the corporate. But for VC, it's more from mentorship, it's more from connection, network, the capital, the guidance that venture capitalists will be able to provide. Hence, they tend to keep it relatively more open. While we were in China, let's just talk about China specific. In the medtech region, just in robotics, in Suzhou, I have about 200 over VCs in that specific vertical, trying to look for companies. So it's very exciting area, not just limited to the corporate. The venture capitalists are also specific in nature, compared to some regional venture capitalists that we have seen, tends to be a bit more generic. They have certain theses, but they are more generic. Like for Joseph, Verge Health Tech, as the name implies, early stage, medtech specific or digital health specific venture fund. Those are the venture capitalists that you should look out for startups who are looking to raise.
Right. Thanks for that, Alan. So let me turn to Wei and Joseph and talk a little bit again about the differences between a venture capital, traditional venture capital fund and a corporate venture capital organization. I think generally people are aware of maybe the differences in goals, where typically, and correct me here if I'm wrong, where traditional VCs are more focused on financial returns, and for a corporate VC, it's more about the strategic interest and strategic fit. Investment horizon obviously differs, where I guess a traditional VC is 5 to 10 years, and with a corporate, it's maybe more evergreen, I think, as Wei was suggesting earlier. But what are maybe some of your comments on the approach or the motivation to exit at some point? For the audience here, you can tell us a little bit about that. What motivates or pushes a VC versus a CVC to exit? Is there even is an exit discussion even relevant in the case of a corporate VC? And I think something that Alan was starting to talk about is how can each of those types of investment organizations benefit startups, because they benefit startups quite differently. And maybe Wei, I start with you on this.
Sure. Actually, I want to add on to what Alan just mentioned. Actually, there is a spectrum of corporate venture, depending on how strategic they are. And also, what is the purpose of using equity investment as a tool to, fuel the innovation of the corporate? Just give you maybe some additional examples. Some corporate venture, they may be reporting to the CFO office. They might be, set up as a single LP fund rather than, for instance, being a evergreen kind of structure, investing out of the balance sheet. So they could be slightly more financial, and their goal may be to invest to learn about the market or to have multiple shots on goal for potential future acquisition of the corporate, or investing into the white space. That could be, potential strategic interest in the coming years. But of course, more strategic corporate venture have, goal in these as well, but they also consider more immediate or near-term, business product and expansion of the innovation for the corporate. So keeping this in mind and then understanding what kind of corporate venture that you are talking with would help with, how to engage them and how to, establish a relationship and for your future business plan. So here I want to talk a little bit more from the JJDC perspective. So we are a little bit more leaning towards the more strategic side. So the strategic aspect is definitely unique to us. So before we engage in further diligence, we need to justify the business return in addition to financial return of this investment. So some example is that we will consider whether equity investment provides incremental value to just doing a business collaboration with this startup company. And we have different ways and approaches to analyze on these aspects. And from the diligence perspective, we typically leverage the capability of our corporate to do the technical and product diligence or to validate the market need. However, we also have a firewall in our diligence that we will not share the financial, legal, corporate diligence, etc., that are more unique to investment aspects with the rest of our corporates. So we will sign an independent, a separate CDA with the startup company that we do diligence. From the financial perspective, we are looking at the same thing as financial VC. Although we may have slightly less control, we will look to establish more collaborative relationship with the company rather than the controlling aspect of the company's governance. Even though we also take board seat or board observer role in the board. So we will consider the other criteria of the quality of the company similar to financial VC, in addition to taking care of our strategic need. So sometimes we may have a package transaction with our BD team in a strategic round, or sometimes we may go earlier than them, or after we already establish an initial collaboration. And last but not least, we try to add value to our portfolio company, leveraging our network, internal and external network, and also our scientific, clinical, commercial know-how from J&J.
Great,
so,
thanks.
So
Sorry,
go
ahead. Yeah. No, that's very, very helpful, Wei. Thank you for that. Joseph, your perspective on this.
That was a great answer. So I'm going to answer similarly to Wei in that there is also a spectrum of venture capital motivations, although I confess the vast majority of them are financially oriented. I would say that there are some, independent private VCs that value other outcomes, like let's say, how are you impacting human lives? How are you, reducing CO2, reducing waste and efficiencies, creating more equality and encouraging more diversity. But again, the vast majority of VC motivations are purely financial. But the motivations of a VC can also be heavily influenced by who their LPs are. So Wei referenced there are some funds that have single LPs, so it's pretty clear that there is some sort of tie or strategic inclination towards the parent organization. However, if you have a broader mandate, you may have LPs that have, how shall I say, preferences to co-invest in certain verticals or sub-verticals, depending on the nature of the fund, with a greater proportion. And that can sometimes drive the investment decisions of these. You also asked about kind of like the benefit to startups and exit motivations.
Right.
So I think, with venture capital, I think it really depends on who the fund manager is, like who are the GPs, what are their backgrounds. If they're predominantly financial in nature, like ex-bankers or private wealth managers, they're probably going to be able to benefit startups through investor introductions and maybe some financial modeling. If they are more operator in nature, so if they've spent time in industry, or more importantly, if they have actually started startup companies themselves or worked for them, then they can actually go through much more of the life cycle with the entrepreneur. And maybe I'm biased in saying this, but I do think that more operator oriented venture capital funds are suitable for the earlier stages of investment, and the more financially oriented ones are suitable for later stage investments, just based on, their experiences and core competencies. In terms of, the exit motivations, here's somewhere where, I think VCs and CVCs might butt heads a little bit. And again, it depends on the nature of the CVC. If the CVC is primarily interested in adding capabilities and innovations to their own core company, they're going to want to set things up that basically they have an option to buy the startup at any point during its life cycle.
Right.
And not necessarily for the maximum valuation possible, which is at odds with the VC who wants to get the maximum valuation possible for an exit. And this is historically where I've seen some disagreements. One way to try to mitigate this, and this is assuming you have any control whatsoever over the process, is generally have a neutral party lead the round. So a non-corporate to lead the round and have the corporates follow, depending on how inclined they are to do that. So at least the lead investor can set the terms, and then the CVC is negotiating against both the investor and the startup in terms of which terms are going to be showing up at the end of the day. That is not always a luxury, especially in our sector. So that's kind of it. I think, just really, really try to understand the motivation of the investor who is investing in you, regardless of whether they're corporate or private, and understand that if it is a larger organization, you are dealing with the organization, not the individual. Individuals change. As a small fund, we've basically signed our souls away for the next 10 years. However, if Wei gets itchy and wants to change to, maybe Novartis's venture team, then Alan might have to deal with someone other than Wei, which may have a completely different view on how to do things. And sometimes it's good to have this expectation kind of contractually written out, because if there's a lot of gray areas, then that's open to interpretation when you have succession in play. And I think this is just a general guidance of working with corporates in general, not just investors.
Great comments there, Joseph. Thanks for that. Alan, you've been nodding. Are you basically agree with this? Anything that you want to add from your observations and experience and in terms of working with both these types of entities?
No, just when he was sharing about the change of personnel in the corporate, I mean, we do get a fair share of that, and we need to update that individual about the history, about why we sign certain deals, and at a point of time, what will our thought process, because some of the terms are not very specific in nature, but more verbal. I mean, you can cover as much, you will end up with 100-page shareholders agreement, which it becomes very difficult to agree upon. Hence, generally, I think the key terms are there, but the motivation behind certain clause needs to be shared with whoever comes on board.
Right.
But so, on top of that as well, if Wei would tend to go to Novartis, I would also try to get her from Novartis, since she kind of invested me once from J&J. I guess Novartis would have a second chance.
That's good to hear. So Alan, what typically when you are approaching investors, what are the types of characteristics that you're looking for in an investor, and are there any red flags that you come across that indicate that perhaps a potential investor may not be a good fit for you as a startup?
Typically, even from a startup perspective, even though, I mean, we are not flush with cash, there are startups who has abundance of cash. But of course, every startup has a life cycle. Most of the startup, if you have not kind of been cash tight once, or kind of near bankruptcy for once, you have not gone through the real entrepreneurship route. That I could confidently say so. But of course, as a company, we are selective on who we bring on board. Generally, we are okay with most financial venture capitalists or even CVC likewise, because as a founder, we want to get the product into the market. We are looking at the clinical outcome, how much impact can we make. But on the other hand, we are also in it so that generally we will get a good return of our investment of our time, resource, our experience, our skill set. So those are the things that we are looking for. So any VC who is not looking at scaling the company is somewhat we are not interested in. But like I mentioned, none of the VC would do so. But there are typical VCs that have a different opinion about how a startup should be running. Generally, VCs or angels, they are not supposed to intervene too much in terms of the operation, because as a founder, you start the company, whether you are looking for deep tech or capital heavy development, or you're looking at high volume consumables that churns out millions on an annual basis, but with a very low margins. So those are your strategy and how you develop the product. Don't get influenced by angels or individual or even certain stakeholders that try to veer you off the mission statement or the purpose, because it will just get a bit messy in terms of the employees, in terms of the other stakeholders will be wondering which direction the startup will be heading. Try your best to look for partners that's more aligned towards what you are trying to building, and not, for example, during COVID, kind of triggers you to venture into developing COVID related stuff. So look for partners who is aligned with your vision and not just in for the quick buck.
Yeah, thanks for that, Alan. Turning to Wei and Joseph now, can you maybe give us an example of a particularly compelling investment that you've made, and what made you particularly excited about that investment? And Wei, maybe I'll start with you.
So for Asia Pacific, we actually haven't made an investment in a medtech company yet. We have a couple of investments in the biopharma arena. So probably I will give you some high level criteria what we are looking for in the company that we invest. So first and foremost, like I said, there is a strategic interest that we need to first analyze of this company, and if it fits with our strategy, and there is importance of working with this company, and there is value add through equity investment, then we will proceed to the diligence. And in the diligence aspect, we will look for some other aspects, just like VC fund, for instance, whether this is a good management team, and especially whether this is a long-term partner that J&J can collaborate with. And sometimes you will see founders, they are very hung on to, for instance, valuation or even the total deal value. This might raise some red flag to our investment. If in the diligence process, a founder and management team is very difficult to negotiate or work with, then the long-term relationship may not be very constructive. And the other aspects, we will definitely look at the market need in the long term, and whether there could be good financial upside. We also care about that. Typically, for Asia Pacific companies, the valuation is slightly higher compared to the US, EU, or Israel companies, in the same stage. So we will look for a reasonable valuation and deal terms. Either we lead the round or we work with other syndicate. We will look at whether this is a reasonable deal for us to work with. And some other aspect is that sometimes we will, if we don't do a business collaboration immediately, we might try to arrange a side letter to include some of the strategic scope. I think Alan mentioned about this. So whether we can get the strategic rights that we want through negotiation is also another consideration for our investment.
Right. Very good. Thanks for that. Quick reminder to our audience. The cohort who are on the webinar here, you can just input your questions in the Q&A, and we will address them during the Q&A session a little bit later on. Joseph, a particularly compelling investment for Verge that you want to talk about?
So I don't like to play favorites. So maybe what I'll do is
Fair
I'll just
enough.
pick the most recent medical device company that
Yep.
we invested in. This is a company called Vitruvian Medical Diagnostics. It is based in both Johannesburg and in Singapore. Most of their business is still in South Africa, but they are looking to, now that COVID seems to, well, it's not over, but we're able to move until the next big variant. They're looking to expand here as well. And what was really compelling about them is that they combine something very low tech with something very high tech. So, one of the big trends, which I think was accelerated by COVID, was the adoption of telemedicine,
Right.
the concept that telemedicine can take place. And, step one of telemedicine is a glorified Skype call, not unlike what we're doing right now. The next step of telemedicine is, okay, how do you add telemetry to that? The next step of telemedicine after that is, how do you now specialize into, specialty medicine, like what, or specific branches of medicine. Radiology was actually the very first one that was able to be done completely remotely. And you'd think that with images, you should be able to do pathology as well. But the sad reality is that telepathology is nowhere near as present as it should be around the world, simply because you have an image acquisition problem. While X-rays, made the big transition to digital in most of the world, much of the microscopes around the world that pathologists use are still analog. All right, so you've got a really big install base of analog microscopes. Some of them might be 100 years old, sitting in Sierra Leone with fine German optics, but they were like 100 years old. So what do you do? Well, thanks to Internet of Things technology, you can now swap out the eyepiece, put in a high def camera with really good optics, hook it up to a 4G connection. And I was in Rwanda in March, and Rwanda is one of the poorest countries in the world, but it's also one of the fastest growing ones in Africa, and seems to be adopting the Singapore model. I was in the middle of a village with no power, no electricity, but I had 4G. I had perfect 4G. So imagine you've got now a device that can plug into any analog microscope, has a 4G connection, can be charged by solar power with a USB connection, and you've got telepathology. You've got the ability to capture high quality images, send it anywhere in the world, and then do something with it. And this is where the high tech happens. The high tech is, okay, you've got an image. What do you do with it? Do you allow the pathologist to do the tedious, time-consuming, or the hematologist to do the time-consuming task, or do you kind of hint to them what they ought to be looking for? So this was used successfully in malaria diagnostics, in automated looking at blood slides, 95% accuracy. And then they made this weird realization, and this is where kind of the opportunism of entrepreneurs that are looking for great sorry, that's a very redundant phrase, but basically the scrappiness of entrepreneurs come in. This is where the big difference is. Do you stay in your lane, or do you seize an opportunity? So they noticed that the math that is used to quantify malarial parasites can be applied very effectively to fertility. And so now they're looking at the same analytics that would have been used on protozoa to look at gametes and to look at the health of embryos and all that, and they've been very, very effective at this. And I don't want to give too much away, and I also don't want to sound like I'm pitching too much, but as an early stage investor, you have to fall in love with your companies,
of course,
or else you wouldn't invest in them. But they're able to really, really enhance not only public health and infectious diseases, but they're also able to dramatically make IVF faster, cheaper, and more accessible.
Right.
So this is something that is a game changer, but happened kind of by accident because they recognized the parallel use of an existing technology. And then the next step is solid tissues. They look at cancer, they look at other things, but really, really excited about
very
that
interesting.
one.
Very interesting.
So, yeah.
Thanks for sharing that, Joseph. One question I did want to ask both you and Wei as well is what milestones in the development of a company typically drive value? And maybe I'll turn to Wei first. Where should a medtech or a health tech company be by the time they get to a Series A, from your perspective, what should they have accomplished in terms of trials, clinical evidence, proof of market demand, health economic evidence, and so on? What are your thoughts on that way?
Right. So of course, with these years of abundant capital, the Series A could be the new Series C. So,
right.
But more typically, we see a medtech company or tool diagnostic company have established a prototype, have built their prototype through the seed round, and then by Series A, they have already fully built their product, and then they have achieved certain level of product proof of concept. For instance, for medical device, it could come from animal study or a few example of human study in the Series A. And then by the time of Series B, they are serious about product launch, and they have showed certain readiness for regulatory approval and commercial launch. So I think this is the more typical milestone that we like to see. Of course, for corporate venture, maybe we focus less on the series of financing round rather than the level of proof of concept or the actual stage of company development. So the financing series actually matter less than the actual development stage of the company.
That makes sense. That makes sense. And Joseph, very quickly, in terms of Verge Health Tech's view on milestones that drive value for your portfolio companies.
So really quickly, I mean, first is the weak prototype, kind of like the de-risk science. The science works. We've got something that sits on a benchtop. The next driver of value is the prototype that is similar to the ideal form factor. Next is regulatory approval. Next is revenue. I think those are the key milestones. In digital health companies, which is a little bit out of scope, I think it's, at least for this discussion, it's more about some sort of traction.
Yeah.
And then regulatory.
Yeah. In terms of number of users, number of that sort of thing. Good. I want to talk a bit about valuation, and maybe I'll turn to Alan first on this, and then we'll hear it from the VC and the CVC in a moment. How did you typically arrive at your valuation and your valuation discussions in your pre-Series A round and your Series A round? Was that something that you proposed to your investors, and you then negotiated, or how did you sort of enter and tackle that conversation with your investors before they became your investors?
I think generally, as what Uwe has mentioned, valuation in specific part of the world has certain disparity. I mean, Southeast Asia has not been the best area to get a high valuation. If you're looking at that valuation rise, you're typically looking at China or US in terms of the bigger market. They usually will be able to accept a much higher valuation consideration. But in Southeast Asia, typically when we benchmark ourselves against our peers, if there is someone similar to ours. Usually like what Uwe mentioned, at the Series A, there's certain product readiness. Series B, you are ready to go to the market. And at certain point, there's always the X amount of capital that you will utilize or will you budget in order to go to the market for you to reach the next milestone. And for that, usually we take a roughly 10 to 20% approach in terms of the dilution that we are looking at. So that's one way to look at it in terms of how much you're willing to give up the company in order for you to reach the next significant milestone that we are looking at, so that you don't have a 2x return, but you get a kind of 4x, 5x return even for your shareholders or even for yourself. How you're going to grow the company exponentially rather than just a pure linear growth. If you're looking at incremental increase, I mean, that's not a startup or venture capital. You are talking about a small business that we are looking at. So typically, it's either through the capital that we need, the dilution that we are willing to forego, as well as benchmarking against similar companies in the market. And in this particular instance, we are talking about the medtech industry.
Very good. Great points, Alan. Thanks. And Wei, and I'll turn to Joseph as well in a moment. Regarding valuation, do you typically like startups to come to you with expectations, specific expectations in terms of the valuation, or how do you normally tackle that conversation?
I think we typically will ask for the valuation, the post-money valuation of the previous round of the company, and then we will ask for information about what the company has achieved since the last round of financing, and then we will do the diligence on various aspects of the company, and then for private companies without revenue, a lot of times the valuation is based on benchmark and diligence readout. I think Alan mentioned that. So we will look at a similar company in the same space, similar financing history, for instance, the amount of capital they have raised, the development stage of the company, etc. And then we will come up with an internal range of valuation. And then, of course, we will kind of try to understand what could be the expectation of the company, but that may not sway our internal valuation calculation that much. In the end, we are looking for fairness. We are looking for fairness. I think that's what J&J believe in, and we look for the same spirit in the partners. So I think for an ideal partner, we will be able to come to a middle ground or align on these aspects.
Excellent. No, that makes perfect sense. Joseph, anything you want to add to this?
Yeah, I think the valuation question is super difficult the earlier you get in the investment cycle, and you're gonna ultimately butt up against the optimism of a founder who thinks they can take the world over, because of course you have to be a little bit optimistic to not work for a big company, decide to give up a stable life and salary to create something of your own. And I think Alan had probably a million options of a normal life, and he probably sometimes wonders what would have happened if he stayed. But 8 years later, he's now running a very cool med tech company that might change the lives of hundreds of thousands of millions of people if he's able to do this. So all of this was a very kind of lengthy preamble for that. The valuation is more of an art than a science, and I think I go by really 3 principles, and it's not a very pleasant conversation, because as a VC, as an early stage VC, we need some pretty ridiculous multiples to make the math work.
Right.
And you have to ask the question, like, how much do you honestly think this company will be able to exit for? And if you look at historical exit valuations for medtech, frankly, they haven't been unicorns. They've been quite far away from unicorns. And that is a hard piece of data to say, are you exceptional enough to be, a billion plus company? And sorry, unless you're like diagnosing cancer at first stage and doing it for all cancers, I find that's that's very difficult to reach from first assessment. So then the next question is, well, what rate of return do we need as a VC? What's the IRR that our investors expect from us? And then the third question is, what do we think the probability of you as the founder getting there is? Is it 50%, 75%, 10%? And then, you multiply, you do the math, and you figure out what your starting valuation is. And it's usually pretty humbling to the founder, but at the same time, if you walk the founder through the rationale, then there's very little that they can argue against, except for maybe some of the assumptions, because they think that's 100% chance that they're going to succeed, and while the VC maybe thinks it's more like 20. So that's really the consideration. And when you arrive at a number that you both hate, it's the right number.
That's good advice, Joseph. Thank you for that. Look, we are almost at the end of the hour here. This has been a great discussion. Really appreciate it. We have 3 or 4 minutes left before we need to wrap up with our YouTube audience. So maybe just to close, I'll ask each of you to share if you have any general tips, advice for, maybe I'll start with Alan, general tips and advice for other entrepreneurs that are at the point in their company's development where you were maybe 3, 4, 5 years back, in terms of maybe raising money and in terms of sourcing investors, and maybe how they could have how you could have done things differently looking back. Alan.
I have not regretted my journey as an entrepreneur. I will always, very motivated. If it's not for in this particular medtech robotics, I will be still doing something similar as an entrepreneur as well. My advice would be, don't look at Joseph or Uwe as a money sign, because they are not. I look at them as individual. They can add value to the company. Sometimes, I think, to me, networking, making friends, getting the know-how is more important than just give me the dollars and cents, because there are abundance of capital in the market. Even in the capital window that we spoke about, there are still money lying around. It's just that they are not deploying. So I would guess, build the relationship even at the earlier stage, regardless of the VCs, whether they typically invest in early or late. I'm still very well connected to my early stage, some of the venture capital friends, just like Joseph. It's always the relationship. They will always know someone else to introduce you to, because the fact that they are in the area of the capital, while I'm more in terms of the product development as well as the development of the company wise. So make friends, make network. Don't just look at the dollar sign.
Great advice. Thanks for that, Alan. Wei, any final words and tips to our audience of startups eager to raise money?
Sure. Maybe I just want to add a little bit about the current market condition. So I think in the current market, when fundraising could be a little bit tougher compared to the previous years, and for early stage company, I think it's important to look for value-added investor. And I have seen, angel investor that are KOL in Asia Pacific, or some of them, some of these KOLs or founding partner who has operating experience before they started their fund. This could be good, early stage investor for your company. So building the relationship with these kind of KOL early on would be helpful before you are ready for the institutional investor or corporate venture. And it is good to have corporate venture in your syndicate, especially for medtech company, because corporate venture typically do more deeper technical product and market validation. So other syndicate or investor in the market, they might look at corporate venture in the syndicate as an endorsement for your company.
Great, thank you for that, Wei. And Joseph, final tips and advice to our audience here.
Maybe contrary to every panelist here, but not all sources of investment are VCs, as Wei mentioned with angels, and not all sources of money are investment. So I challenge you to look beyond, your traditional, financial instruments and financial organizations to see what else is out there, especially in these difficult times. There's tons of money out there. There's tons of causes, tons of people and institutes that care about something that you're working on. So you've got to find them and not, pigeonhole yourself to say, I must raise from a VC or an angel syndicate. That's all.
Very good. Thank you. Thank you for that. Very final question. If companies in our cohort are interested to contact you, what's the best way for them to reach you? Would you be open to sharing your email address to our cohort companies? You don't have to do it now, but if you're okay with that, we will communicate that in the chat to our cohort companies. Would that be all right with you, Joseph, Wei? Okay. Alan?
It's fine. Although to make sure that we get to the right target, it's always best to apply through our website, because we have a lot of different skill sets on our team. And sometimes if it goes to me, if I'm on an airplane and someone else, might want to pick this up sooner.
Good point. Good point. Is there a process for J&J as well for companies to express interest?
So I will welcome everyone to check out our website at www.jjdc.com to learn more about our investment areas of interest, team, and to follow our news. And welcome to connect with me on LinkedIn, and we can have a personal introduction from there.
Perfect. Right. Well, we're over time. Alan, Joseph, Wei, thank you all so much for being part of today's panel. This has been really insightful. We are going to end our broadcast on YouTube. Don't go anywhere. We still have 30 minutes of Q&A with our cohort companies, so stay on the line. But I'll ask Firda to disconnect us from YouTube, and we'll just hold on here for a second. So thanks again.